Good morning, traders and investors. Roger Scott here. It's Wednesday, it's August 9th, and it's about 8:07 in the morning. Market's not going to gear up to open for another hour and 23 minutes. Before we get started, make sure to like this channel if you're watching it on the YouTube channel. Second of all, make sure to subscribe to our Telegram channel. If you don't know where it is, go to rogerscott.com/Telegram. Most importantly, I've opened up my VIP room for the summer. Yay! Today at noon, Monday through Wednesday at noon, Thursday and Friday 11 a.m. It's happening at noon today. Don't miss out. Let's get into today's video. And comment below the video if you have a question. I'll respond. I love responding to the comments. All right. So as you can see here, the market's up a little bit after yesterday and Monday's draw. We've had a little bit of a down day. I'm looking at the major sectors right now. I'm looking at technology just to give you a broad perspective of where we stand right now. I'm looking at the market, and again, we are breaking down, but it looks like we're pivoting a little bit here. It looks like we're going to have a little bit of an upside move. I like the close here, and I like the fact that we're trading above. Also, when I looked at Apple, remember, earnings for the most part are behind us. When I looked at Apple, even Apple looked oversold at this area. So, and we're at resistance. So, doesn't mean we're necessarily going to go back up all the way, but it could mean we can come up and fill the gap, have a couple of up days before coming back down. But I'm inclined to believe that this might have been the top based on what I'm seeing, the reaction that I'm seeing from XLK and the reaction that I'm seeing from QQQ. Basically, there's really no reason for the market to go higher again, but it doesn't mean it can't congest and sit around here for a while. So again, I'm a little more optimistic than I was 2 days ago, and earnings aren't as bad as they were projected to be this week. But and we may have a little bit of a pullback to the upside. Some of the tech stocks are looking good, but I would be very, very, very cautious. I would be very, very cautious about the state of the market right now because of all the vulnerability, and we have a big report coming out starting tomorrow and Friday. So bond market is where you want to be right now in terms of what you want to watch. Now, we bounced off of this level, but I'm not convinced we're going to go higher all the way. And we haven't changed our status. It's still an 85, 86% chance that the Fed is going to take no action. But again, downgrading bank stocks, Moody, Finch, the sentiment went from being hyper bullish to somewhat cautious. And from the word on the street is COVID is starting to come around. China's not doing well. So be careful. And if the CPI tomorrow is better than expected, that's a green light for the Fed, right? To continue raising rates, because if the numbers are better versus means what they're doing is working and they can continue increasing. That means there's some strength there. So it may be one of those situations where positive news is bad for the market, bond market, and good news is good news is bad and bad news is good, because it may do the opposite, because it may interpret it as Fed getting a license to take more action versus no action. So you want to keep your eye on the long bond today, and especially tomorrow ahead of the CPI. Speaking of the CPI, just to give you a little perspective of where we're at with that, we're looking at the CPI and they're looking at the core. All we're looking at is the core right here. I don't care about any of this stuff. Well, year to year, fine, but core year to year and regular year to year. But this is what the Fed is going to look at, and they're looking for the number to be 4.8. If this number is 4.9, it's still okay. But if it's 5, 5.1, 5.2, that means that what they're doing is not having the impact that that we had hoped for fast enough, and then they may start saying, well, inflation is not moving fast enough, which means gives them a license to raise rates. Raising rates means lower bond prices. So if this number is not good, it can cause impact. So keep your eye on the bond market, especially today and tomorrow. I think today's going to be a light day aside from earnings. And I think we have Disney today. I think that's about it as far as big companies. But keep your eye for tomorrow for the CPI and Friday for the PPI. Those are the big reports. Now, as far as the broad market, just kind of want to show you where we're at right now. Oops, excuse me. Wrong ticker symbol. If you look at the Dow Jones, you'll see that we're still hovering near the highs. We're coming off, but we're hovering near the highs. The QQQs are starting to look weaker, but again, after this isn't major weakness, and yesterday we had a reversal day. Look at the intraday data. We opened down, and we had a nice V reversal taking us all the way back up. So the way I'm seeing it, we're opening higher, we're coming back higher. We may have another up day before taking us down. The SPY is not as strong, and it has been coming down a little bit more. But again, keep your eye on this data. We need to break this low. Otherwise, we're going to go back into this channel and we can test the high. So again, be very, 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 very cautious right now. Let's talk a little bit about global economy. Then I'll talk about sectors, and then I'll give you my favorite stocks and the worst stocks on my agenda. So market participants are exercising caution in anticipation of tomorrow's inflation report. S&P fell to a 3.5-week low. Blue chips dropped to a 2.5-week low. Nasdaq dropped to a 4-week low. So you can see the Nasdaq is definitely the weakest one here. The S&P has a lot of blue chips, which is the Dow, so it's taking it in between. Financial stocks slumped, but not nearly as much as I thought they were. Actually, regional bank stocks didn't do so bad. They actually went down, and then they rallied towards the end of the day. Here, let me give you an example. So this is another reason why I'm a little more bullish than usual, because if you look at KRE, the regional bank stocks yesterday, look at this. I want to show you this. This is why it's important to not just read, but to see what happens. So look, they opened here, and look what they did till the rest of the day. And if you look on a daily chart, they closed right up here. So they weren't all that weak. They started out weak, but they didn't close weak. So we got to pay attention to that. We got to pay attention. So the banks actually shrugged off this data, which is a very good sign. Now, what does the Fed say? Harker said Tuesday that central banks could potentially halt rate increases unless there's unexpected developments in the economy, but he emphasized that rates would need to remain at their current elevated levels for a considerable period of time. He also noted that sometimes, probably next year, we'll start bringing rates down. We'll see about that. There's an 86.5% chance that the Fed is not going to do anything in September, and we have Disney, Trade Desk, and Manulife financial earnings. Again, the fact that regional banks shrugged off negative data is good. Crude oil inventories come out today in about 15 minutes, and I'm actually really bullish on energies. I'll talk about that in a minute. Europe, they're digesting more corporate earnings results. They're looking at Italy, and they're tracking U.S. right now. China, oh boy, they closed lower as investors digested data indicating the world's second largest economy had fallen into deflation. Now, I'm going to tell you something. One of the biggest factors that could drive U.S. economy into a recession is China. It's like you swimming and somebody tying up a 50-pound barbell to you while you're swimming. It's a problem. It's a big, big problem. Data showed on Wednesday that China's consumer prices dropped for the first time in more than 2 years in July, while the country's factory gate prices index fell for the 10th consecutive month. Wow. Weak China inflation data follows disappointing figures on imports and exports for July. This is going to eat into America. It's very hard for it not to. Sorry, you're hearing my phone. I apologize for that. Posing further economic challenges for China as its post-COVID recovery loses momentum. So again, if China can't get it up, sorry for that visual, but if China can't get it together, it's going to be a major problem for U.S. It's going to add something that the Fed is not really pricing in too much right now. Japan is weighting in weak earnings, also weighted on sentiment. Nikon Corporation, I thought Nikon was out of business already, plunged over 11%. I thought they stopped making cameras. Or I heard about that years ago. I guess maybe not. Who knows? But anyhow, they're digesting earnings. Earnings have been mixed. They haven't been bad, but Walt Disney is blue chips. Blue chips, tech is pretty much, large cap tech is pretty much behind us. Now, looking at the sectors, if you look at the cumulative on my short-term scan, you could see the cumulative. You got energy, financials, and communication services. Now, communication services are a subpart of technology, but they've been coming out with really good numbers. And actually, quite honestly, the charts today for Meta and Google don't look so bad. And healthcare and the Dow. So outside of communication, which doesn't have Amazon, Apple, Microsoft, communication is the only one that's up here on a cumulative. On a 6-week basis, same thing. Small caps, mid caps, a little bit of consumer discretionary, but technology's all the way up here. But look at what's been going on between 6 weeks and 3 weeks. Look at consumer discretionary, look at technology, look at QQQ. Basically, technology's been just horrible. Energy, healthcare, consumer staples are starting to come up with energy down, the Dow Jones, and then communication, and then financial. And if you look at the last week, the last few days, healthcare, energy, consumer discretionary, financial, consumer staples, Dow Jones. Dow Jones is pretty much consumer staples, financial, energy, and healthcare. So from where I'm standing right now, you don't want to be long technology. Now, Apple is a conglomerate. Apple looks pretty good right now, but you don't really want to be long technology. It's much better if you focus on energy, healthcare, financial, and consumer staples, or the Dow, which makes up consumer staples, financial, energy, and healthcare. So that's where the market cap, you don't want to be in tech right now. Broad tech, it's not good. So what am I looking at, right? What stocks am I looking at? Well, I like Schlumberger. We're actually long this stock right now, and it's opening up about 0.87% to a swing high. Don't say I didn't tell you. I did. Look at that stock right there. Breaking up. I like it. I like APA, which is a natural gas stock, also an energy stock. I like how it's midstream right now. I think it can go all the way to the 45 level before pulling back. But it's doing good still. It's still doing good. I like APA. And I like the U.S. oil fund. If you look at the U.S. oil fund, you'll see that it has mostly, it's a energy, it's basically tracking the crude oil sector. So, and it's looking good right here. And what I love about it is it's breaking up all the way to this level past the recent high. So it's looking really good right now. That's the recent swing. And it's breaking past that level right now. And it's moving higher, and I really like that. So I like energies. We have the crude oil report coming up. Now, downside, T-Mobile. I don't like T-Mobile. Higher, couldn't break this high right here. Pretty much made a swing high. Don't like the RSI that's coming down. I would be selling this or buying a put. And if I was buying a put, I would be buying the, let's see here. I'd be buying the 140 put that's expiring in 37 days. Implied volatility is not that high. Then you have Mondelez. Mondelez is a consumer staple company, but it hasn't been doing that great, and I think it's got a little more downside to go. I think it can go down to the $70 level. Then we'll have to see where it goes. For that one, I'm not as bearish on that one as I am of the T-Mobile, but on that one, you can go to puts, and you can go to the 74, 73 put. Let me do T-Mobile again. I thought I might have given you calls by accident. Hold on. 9/8 expiration right here. 136. Sorry, I might have given you calls before. 36 strike price right here. That's where the money is. You don't want to go too far out, and you can also sell the 130 or the 129. Go 5 strikes out if you want to give yourself a little credit. Make sure you get at least 50 cents for the selling side and go at least 5 points out. Now, before I let you go, I've got something really, really important that I need to tell you. And I really need to tell you this because, folks, this is important. Today, Mr. X will finally be making a reveal at 11 a.m. Eastern Time, along with his broadcast, exposing how money moves in secret on Wall Street. He also tells you how you can use this highlight sensitive information to target what could be the next executive payout hitting a certain stock this very week. Now, Mr. X has been meeting with top Wall Street and Fortune 500 firms, taking a peek behind the curtain. And he's going to spill the beans, showing everyday folks how to activate their own executive payouts, all by placing quick trades when a certain piece of paper hits the desk. Click the link below, learn more about it, and join Mr. X at 11 a.m. today. Don't miss out. I'll talk to you guys later. Make sure to like our channel, subscribe to my videos, subscribe to my Telegram, and comment below this video. Bye, guys. I'll talk to you later. Hope you got some value out of this video.